Hello friends, last week we came to within kissing distance of 20,000 levels on the Nifty 50 spot. And on Friday, the markets delivered a sucker punch to the bulls and fell sharply. Are the bulls tired? Is the bull party over? Well, the market statistics and internal data does not seem to indicate that the party is over, not by a long shot. For those of you who are interested in finding out what the statistics indicate, do stick with me till the fag end of this video. Jump right into the statistical data, and coming up on your screen is the market roundup window, which tells you that it was the banking segment that powered the rally because the bank nifty rose faster and harder than the Nifty 50. The US dollar index, the Dixie, rose a full 113 basis points, and that basically was a party pooper of some sorts. Gold and silver reacted because a strong dollar is basically bearish for commodities. Crude and natural gas bucked that trend, but do remember I told you in my last week's video that the hurricane season starting from July till the end of October, sometimes it extends to November also, is historically a bullish time for energy. The USD INR, which is the dollar versus the rupee, eased by 20 basis points, which tells you that the rupee gained traction against the dollar. Indian 10-year benchmark bond yields rose up by 1 basis point, which tells you that bond prices came down very, very slightly. NSE market capitalization went up by a little under a quarter of a percentage points. The MWPL market-wide position limit went up by 1.51%, and of the overseas indices in the US, it was the Nasdaq which came down, whereas the Dow and the S&P 500 rose. As a matter of fact, the Dow and the S&P 500 are near April 2022 highs, and that's adding tailwinds to the domestic markets. Let's now come to our in-house indicators. I start with the market-wide position limits, the MWPL, which is nothing but the percentage exposure utilized by traders as a component of what SEBI allows in total. What we are seeing is in the week before expiry, we have reached 37.44%, which is the highest in the last 4 expiries that are covered in the chart. So the big ticket traders have been writing out bigger checks, and they are showing conviction. And this is what is leading to volatility. Remember what I've been writing in the mint, that transfer of ownership from weak hands to strong hands is not an easy process. It's full of volatility because one side will surrender their positions, and positions are at a high currently in the 20-week chart. So when one side surrenders their position, and that's lots of them because buildup has been high, prices move exaggeratedly. So what we need to watch out is whether the 38% level is reached. Now that would basically tell you that there's extreme amount of risk. Probability of that happening is somewhat less. Let's now come to the stock and futures turnover. Remember, these are concurrent 3 expiries, so July, August, September. Both the index and stock futures turnover went up, which tells me that one marshmallow traders participated well in the up move, which is a thumbs up for the bulls. I now come to the advanced decline ratio, which after the price is the most leading indicator of which way the winds are blowing. It remained above 1, although it eased marginally to 1.07 from the prior week's 1.11. So for every 100 losers, there were 107 gainers. Not surprising that the advanced decline ratio has come down because at new highs, there are always weaker hands willing to book profits and encash because they feel the market has gone high enough. So as long as the ratio remains above 1, prices are climbing, bulls are still in the driver's seat. Friends, I now come to the Nifty and Bank Nifty prompt futures basis analysis. Now, this basis is basically nothing but the premium or discount prevalent in the futures of the indices compared to spot, and this is Friday on Friday. So what we have seen is a sharp compression in the basis of the Bank Nifty, which has fallen more than half. The Nifty basis has come down by 10%, which is because two marshmallow traders have unwound long positions, especially on Friday, where the sell-off was the most pronounced. Also remember that basis tends to contract as we approach closer to expiry, just like your options premium contract close to expiry. So as long as the basis remains positive, bulls still have a chance. Friends, I now come to our in-house exclusive indicator, not available anywhere in the public domain. You've enjoyed it and trusted it for more than 2 years now, the impetus. The Nifty impetus is at a period high and continues to rise sharply, whereas the Bank Nifty impetus has risen remarkably but is not at a new high. So that tells me that last week's upsurge was accompanied by a good deal of buying momentum, forceful momentum, and there was a good amount of buying support at lower levels. And that tells me that the party is far from over. Friends, I now come to our second exclusive in-house indicator, the LWTD. You've trusted it again for over a year and a half now. What we are seeing is the Nifty's gains on a week-on-week basis have contracted slightly to 0.92% last week, but the LWTD is at a period high. So what it tells me is that I would expect, or I should expect, more proactive fresh buying support or even short covering support on declines if the markets were to contract. So it tells me that the party is not over. There could be a comma, but not a full stop to the ongoing rally till the LWTL does not go below zero. Friends, our in-house indicators done. I now come to the bond market. Do remember, we have been leading our contemporaries where coverage of the bond markets is concerned, because we believe the bond market fuels the prices of the other asset classes, and traders, particularly in the banking space, should ignore bond yields at their own peril. So the Indian benchmark bond yield has moved only by 1 basis point on a week-on-week basis, as the weekly chart on your screen tells you. We are below the support trend line and currently are in no man's land as far as I am concerned. So we are not hitting 7.5, 7.6 levels where I would start laddering, and nor are we going below 7% where I would start to buy gilt funds. So status quo maintained. Do remember, early August, we'll see the Monetary Policy Committee meeting of the RBI coming out with its interest rate decision. So bond markets are on a wait and watch mode till then. Friends, the bond market's done. I now come to the Bank Nifty, which led the charge from the front. What you are seeing on the daily chart on your screen is that this index rose on 3 out of 5 trading days. Friday saw resistance to the upside because of the long leg doji, accrued long leg doji being made on Friday. The price remains above the previous swing high of 44,152 levels, which is now the de facto immediate swing support. Though the month-long moving average, which remains upward and the price remains above the moving average, is a day trader's support. But for a swing trader, the 44,152 level is the support to watch out for. Now, moving to the weekly chart, what we are seeing is that the Bank Nifty has made a power candle. A power candle is a large, prominent candle. It could be bullish or bearish, but it is fairly large. And what you are seeing is that the Bank Nifty has made a bullish power candle. So it is basically outperforming the Nifty as far as the previous week's performance is concerned. Now, if you watch the Nifty segment, I'm going to tell you why another piece of statistical evidence seems to indicate that the bull party is not over yet. Okay, so the price remains above the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium term outlook for the bank Nifty also remains positive for now. Now, last week, this index was at number 4 on our statistical beta rankings of volatility, and it jumped 3 notches to hit number 1 last week. So the bank Nifty was the most volatile counter all of last week on statistical beta ranking, which tells you that the challenge level, the hurdle rate for the retail investor was fairly high on the bank Nifty. Last week, I advocated a range between 45,900 on the upside and 43,725 on the downside. Admittedly, the upside was exceeded by 469 points to 46,369 levels. In the coming week, I expect an estimated range between 47,200 on the upside and 44,950 on the downside. Friends, I would suggest you cut down your exposure levels on the bank Nifty because of the sheer volatility that it is reporting. Coming to the Nifty 50, which underperformed the bank Nifty, and it gained only 0.92% on a week-on-week basis, but it gained on all 4 out of 5 trading sessions, as the daily chart on your screen indicates. Now, this decline on the Nifty 50 was predicted by our LWTD indicator, which I had posted on Thursday night on our social media accounts. So if you make the effort of connecting with us on social media, you could basically stay ahead of the crowds, particularly on our free Telegram channel where I post the most amount of our data. Now, the price remains above the month-long moving average, which tells you that the short-term outlook is also positive for now. Coming to the weekly chart, what you are seeing is a bullish candle with a very small body, but a prominently large upper shadow. Now, this is a shooting star of sorts, and it is the second one made in the third week itself. In Japanese candlestick parlance, this is called the Nagareboshi formation. It basically indicates that the bulls attempted to push the markets higher, but failed to hold the high ground, and the market slid back to the lower end of the week's range. By itself, it need not be a bearish indicator. What we do need to see is what happens in the coming week as follow-up buying. So the high of the Nagareboshi candle at 19,992 must be overcome on a sustained closing basis for the Nifty to go to 20,000 plus and stay higher. Now, for the reason why I feel the party is not over. If you remember what was happening on social media up to a fortnight ago, people were advocating that because the banking stocks were underperforming the broader markets, and banks have a very high weightage in the Nifty 50, it is okay if sector rotation occurs and technology stocks were to rise. They also have a fairly high amount of weightage in the Nifty, and therefore the markets could climb. Although I agree with this hypothesis partially to a very small degree, I beg to differ in totality. Let me tell you why. I follow statistics. I am a statistical trading models based trader. The reason why technology stocks cannot replace banking is due to the statistical weightage alone. Now, tech stocks have a weightage of 12.65% in the Nifty, whereas financial sector services, including banks, have 37.59% in the Nifty 50. So, can 12.65% replace 37.59%? I don't think so. It can cushion the decline, but it can't lead to a new high. So I think banks coming back and leading the markets from the front is actually very good news for the bulls. Here again, what will happen in the market in the coming week, nobody knows. But if banking starts to outperform, the party is not yet over. At best, there could be a comma, not a full stop. So, in the week before last, this index was at number 3 on our statistical beta list of most volatile counters. It slipped 2 notches to number 5, which means the volatility, relatively speaking, came down. It's not that the Nifty's volatility has fallen, it's just that individual stock volatility has risen faster. Last week, I advocated an estimated range between 19,950 on the upside and 19,175 on the downside. Here again, the upside was exceeded, but by 42 points only, because the high was 19,992. In the coming week, I estimate a range between 20,125 on the upside and 19,350 on the downside. Now, friends, I come to the last bit of statistical analysis, wherein I measure the risk appetite of the average retail trader by the sheer footprint of which segment in the derivative space has contributed to how much turnover. The chart on your screen basically tells you that the index futures turnover, which is indicated as a blue line, has gone up by 2 basis points. The stock futures turnover contribution has gone up by 6 basis points. It is indicated as a red line. So the highest risk and highest capital intensive segment, which is the futures segment, has contributed higher turnover, which tells me that risk appetite was definitely higher. Now the lowest risk segment, which is the index options. Now index options are indicated as a green line. That contribution fell sharply, and it was made up by a sharp rise in stock options turnover. Here again, people are shunning the lower risk and lower volatile instrument, which is the index option, and going for the higher risk instrument, which is the stock option. Net, I think retail traders showed extremely good amount of risk appetite, and should follow-up support come in this week, in the coming week, I think the party is not over, not by a long shot. Now, friends, for my strategy for the week ahead, and I would basically target those stocks which have lower standard deviation, for the simple reason, at new highs, the volatility is likely to be extremely high. And those of you who followed me long enough on social media will remember I've been talking about, or rather warning you against trading, at least for intraday, those counters where the spreads are more than 5 or 6 ticks. So I would enforce that very, very diligently. I don't want to trade counters with spreads more than 5 ticks. I would particularly target PSUs, public sector units, and within the PSUs, I would also target public sector banks, which will provide trading opportunities in either direction, bull and bear. The direction will be determined by the snapquote window. I have recorded a video last year about why I favor trading public sector units and what are the benefits of trading public sector units. The hyperlink to that video is in the description below this video and in the pinned comment under this video. So please do watch this older video, but it's still as valid. Oil and gas drilling and exploration companies may do well, relatively speaking, compared to other sectors. As I mentioned earlier, I'm not laddering into sovereign debt yet, or deploying fund in gilt funds as yet. In the commodity space, I advocated last week that silver should see some consolidation because of the extreme run-up that it has seen in the last few weeks. Sure enough, silver corrected. Now, I would need to watch out for the US dollar index, or the DXY, for directional guidance on bullion in the absolute near term. For the long run, I remain bullish on bullion. If your outlook is in terms of quarters and years rather than days and weeks. Oil and gas in the commodity space are historically bullish in the hurricane season, as I've said in my other videos and in my live mint column. So if you are seeking to earn alpha by way of theta decay in the options segment by way of income, I would suggest you go for higher strike prices and not get too aggressive in strikes that are close to the current spot rates. Friends, my strategy done. I now come to the most popular segment of this video, wherein I give you 5 stocks that have gained the most amount of impetus on Friday, where you take small exposure on Monday, wait for large price moves, and 5 stocks that have lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves. These are for scalpers. The list is valid only for Monday, Tuesday through Friday. The list is updated only on our free Telegram channel, so do make it a point to subscribe there. On your screen now is the list of statistical impetus gainers, which is led by Kotak Bank at number 1, ITC at number 2, L&T number 3, Polycab number 4, and ABB at number 5. Impetus losers list is led by PI Industries, followed by Mahindra & Mahindra, then Deepak Nitrite, Tata Motors, and Ambuja Cements. Friends, I hope my videos are helping you decipher the markets better and becoming a more informed and savvy, sophisticated trader as far as statistical data and analysis based trades are concerned. Do let me know how your journey as a trader has improved in the comments segment. And do subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And please help me reach out to a wider audience by sharing my videos with smart traders and investors like yourselves on your contact list, social media groups, etc. I thank you for your patience and sticking with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.